welcome to the Bank of England's Inflation Report press conference. On my left is Manoush Shafiq, the Bank's Deputy Governor for Markets and Banking. On my far right is Ben Broadbent, the Bank's Deputy Governor for Monetary Policy. And on my immediate right is Mark Carney, the Governor of the Bank of England.
Thank you, Jenny. Good afternoon, everyone. So today marks a new approach to monetary policy communication at the Bank of England. By releasing simultaneously our inflation report and the minutes of our committee's deliberations, we're ending the drip feed of information around a single monetary policy decision. Instead, we're setting out our assessment of both recent economic developments and future prospects for the economy in a comprehensive fashion. So one decision with the forecast and all the supporting analysis. I would like to thank a number of you who spent the last few hours locked in one of our vaults digesting that and little else. Now, just to be clear, at the press conference, as has always been the case for inflation report and MPC press conferences, we will speak on behalf of the committee as a whole and represent the MPC's best collective judgment. At its meeting yesterday, the MPC voted by a majority of 8-1 to maintain bank rate at 0.5%. The committee voted unanimously to maintain the stock of asset purchases at 375 billion sterling, and it reaffirmed its expectation that when bank rate rises occur, they can be expected to be limited and gradual. The most striking development in the UK over the past year has been the fall in CPI inflation, which edged back down to 0% in June. As set out in my latest in an expected sequence of open letters to the Chancellor, around 3/4 of this deviation of inflation from the 2% target reflects unusually low contributions from energy, food, and other imported goods prices. The remaining part of the undershoot reflects the past weakness of domestic cost growth and wages in particular. The combined weakness in domestic costs and imported goods prices is evident in subdued core inflation, which is currently around 1%. With some underutilized resources remaining in the economy, and with inflation below target, the committee is setting monetary policy to ensure that growth is sufficient to absorb the remaining economic slack and to generate the rise in domestic costs needed to return inflation to target within 2 years. Conditional on bank rate following the gently rising path implied by market yields, the committee judges that this objective will likely be achieved. The committee projects UK-weighted world demand to expand at a moderate pace, around 3/4 of a percentage point below historic averages this year. The composition of that growth is rotating from emerging to advanced economies. And despite steady global growth, UK exports will still be held back by the strength of sterling. Risks to global growth are judged to be skewed moderately to the downside, reflecting risk to activity in the euro area and in China. At home, private domestic demand is robust and is expected to remain so. This year, household spending has been supported by the boost to real incomes from lower food and energy prices. But more recently, wage growth has begun to pick up as the labor market has tightened and productivity has strengthened. Consumer confidence remains at its highest level in over a decade, and credit conditions have continued to improve, with historically low mortgage rates boosting activity in the housing market. Business investment has made a substantial contribution to growth in recent years. Surveys suggest that this will continue, thereby helping to return productivity growth towards historic averages. The near-term outlook for inflation is muted, and the falls in energy prices over the past few months will continue to bear down on inflation at least until the middle of next year. Nonetheless, a range of measures suggest that medium-term inflation expectations remain well anchored. There's little evidence in either wage settlements or spending patterns of any deflationary mindset amongst businesses and households. Sterling has appreciated 3.5% since May and 20% since its trough in March of 2013. The drag on import prices from this appreciation will continue to push down on inflation for some time to come, posing a downside risk to its near-term path in particular. But set against that, the degree of slack in the economy has diminished substantially over the past 2.5 years. The unemployment rate has fallen by more than 2 percentage points since the middle of 2013, and the ratio of job vacancies to unemployment has returned from well below to around its pre-crisis average. Robust private domestic demand is expected to be sufficient to eliminate the remaining margin of spare capacity, judged to be around 0.5% of GDP, over the course of the next year or so, despite continuing fiscal consolidation and modest global growth. That closing of the output gap, in turn, should generate the rise in domestic costs necessary to counterbalance the drag on price pressures from sterling, and so return inflation to target in the medium term. The MPC's projections are conditioned on bank rate following the gently rising path implied by market yields. Under this assumption, demand growth is expected to be sufficient to return inflation to target within 2 years. Inflation then moves slightly above target in the third year of the forecast period, as sustained growth leads to a degree of excess demand. Underlying those projections are significant judgments in a number of areas as set out in the report. They include the degree to which risks to global growth are contained, the prospects for private domestic demand, the outlook for wage and productivity growth, and the extent to which external factors currently weighing on inflation dissipate. In any of these areas, developments might easily turn out differently than assumed, with implications for the outlook for growth and inflation, and therefore the appropriate stance of policy. So the committee will continue to monitor closely the incoming data, tracking those key judgments, and it will adjust monetary policy as appropriate in order to meet the 2% inflation target in the medium term. As the UK expansion progresses, speculation about the precise timing of the first move in bank rate is increasing. This is understandable, and it's another welcome sign of an economy that is returning to normal. The likely timing of the first bank rate increase is drawing closer. However, the exact timing of the first move cannot be predicted in advance. It will be the product of economic developments and prospects. In short, it will be data dependent. The MPC will monitor developments relative to the forecast, in particular, wage growth, productivity, core inflation, import prices, and the risks to the international environment. And the path of rates is much more important than the precise timing of the first increase. Given the likely persistence of headwinds facing the economy, the MPC expects bank rate increases, when they come, to be gradual and to be limited to a level below past averages. By acting in this manner, the MPC can secure the expansion and build on the hard-won gains of recent years. And with that, Ben, Manoush, and I would be pleased to answer your questions.
And as always, can you please give your name and the organisation that you represent? Robert and then Richard, please.
With unemployment rising slightly and, in fact, employment growth slowing, and on your forecasts, inflation at or near zero for rather longer than you thought back in May, isn't it a bit bonkers to start talking about interest rate rises?
A couple of things. First, the near-term outlook for inflation is muted, as I said, and it wouldn't be surprising if we have another month or two of negative inflation, given the very substantial moves in oil prices and the changes to some of the utility prices as well. We've seen big moves in oil, big moves in other commodities, but also some changes to utility prices. And those mechanically go into the CPI calculation. It makes a real difference to households in terms of their disposable income. But they're one-off effects. So we put them into our near-term forecast. They won't be around. Those effects on inflation won't be around in the 18 to 24-month horizon over which we can influence the rate of inflation. So our expectation is that the rate of inflation is going to pick up. And the issue for the MPC is to ensure that it picks up in a sustainable manner. that it first gets back to target in a timely fashion. We say within 2 years. But we don't want it just to get back to target in order to shoot through the target. We want it to get it back to target, and all things being equal, to keep it at the target of 2%. So it will be consistent in our judgment, in our best collective judgment. In order to achieve that, it will be consistent with rate increases to a limited and gradual extent, but also rate increases, the timing of which, in our judgment, has moved closer than the time that was in May. Because this is not just about inflation, as you know, over the course of the next few months, but inflation for the medium term, so people don't have to worry about inflation. So people can enjoy the dividend, if you will, of lower petrol prices, lower food prices today without worrying about a payback in the medium term. The jobs market, important question. I mean, what we've seen in the jobs market, first off, big picture, taking a step back, as I did in my opening remarks, if you look over the last couple of years, we've had one of the strongest employment performances, not just in the advanced world, but also in the UK's history. And you can cut that a number of different ways. I use the unemployment rate, 2 percentage point fall. In the very recent job numbers, or employment numbers, we have seen a slight fall in employment and slightly less contribution from average hours. Now, there's a couple of potential interpretations of what has happened. One would be that there are actually congestion effects in the labor market. So, in other words, as the labor market tightens, and we see that tightness in a number of ways. The vacancies to unemployment rate is back at historic averages. Job-to-job churn has moved up quite sharply. The amount of short-term unemployment is back down below historic averages. There's a bunch of signs of that tightness in the labor market. So the movements may take time, and you may get these sort of blips that are there. The other thing which does appear to be happening, and we'll learn more about that with time. The other thing that does appear to be happening is we may be seeing this pickup in productivity that's there. And that is very good news for the sustainability of the recovery. It means that the wage growth that we have seen, and we have seen a marked pickup in wage growth over the course of the past 6 months, that is very welcome. The extent to which productivity is filling in around that, that means that that wage growth is more sustainable as well, and so it augurs well for the sustainability of the recovery. So we would not interpret the recent job news as negative for the sustainability of the recovery. And in fact, it's borne out. I'll finish here. It's borne out in our forecast, which has GDP growing slightly above historic averages for most of the forecast horizon, and the economy ending up in excess demand. Thanks.
Governor, in the middle of last month in a speech in Lincoln, you said that the decision as to when to start such a process of adjustment, in other words, putting up interest rates, will likely come into sharper relief around the turn of this year. What's changed, if anything, in the economy that would adjust when borrowers might expect the first rise in interest rates in those 3 weeks?
Well, for a couple of things. One is that my speech in Lincoln is my personal view, and I'm here, as Ben and Manoush are, representing the committee. I was very clear, though, that I was talking about the decision about whether to raise interest rates, from my perspective, would come into sharper relief around the turn of the year, just to be precise. And that's consistent with the forecast in May, consistent with the forecast that we have. In my judgment today. The point is that none of us on the committee pre-commit to any future rate increase, any future point in time that we would increase interest rates. We just took a decision today, and as I said, the vote was 8-1. But what we do see, and this is relevant to the timing of rate increases, is an economy where the slack in the economy is being used up, where we're starting to see wages increase, where we're starting to see a pickup in unit labor costs, where we have some offsetting effects, but the support for a rise in CPI inflation is building. And as we move forward, we will be looking as individuals and collectively as a committee for confirmation of the recent trends in order to make our individual and ultimately collective decision of the timing of when to raise interest rates.
Your view hasn't changed in those 3 weeks.
Richard, if you
Well,
could just keep it to one question in future as well. Sorry.
Yeah.
Heather, please, and then Ed.
Hi, Heather Stewart from The Guardian. It's been quite a lot of activity, turmoil, to use a journalistic term, in financial markets in recent weeks. A lot of concern about the impact that a Fed rate rise later in the year might have. Quite a lot of action in the European market, bond markets, because of what's happening in Greece and also China. It's an extraordinary turnaround in their stock market. How much weight do you attach to those concerns, sort of financial market dislocations, and how does that impact your thinking?
Yeah. Well, I think the first thing I'd say is I wouldn't characterize what has happened recently in financial markets as being turmoil. I would characterize it as being there's been volatility. Financial markets have been adjusting to news. The situation in Greece was a steady feed of news about an important situation. I think we learned a number of things through that process, one of which was that some of the defenses that had been put in place by European authorities were holding, importantly, and that is, it's consistent with the committee's view in terms of the scale of likely contagion if there were to be an unfortunate outcome in Greece. Obviously, events in China are important. They are important first and foremost, though, from a perspective of global demand. It's why we have one of our downside risks to global growth. The financial links to China are nowhere near as strong as the scale of that economy would suggest. Now, there are some financial links from the UK, but again, these were not factors that were weighing on the committee's decision in any form. I mean, we will have to make a judgment about the precise timing of raising interest rates, and one can expect that financial conditions, there will be some tightening of financial conditions as a consequence of that, but that is part of the purpose of raising interest rates, and we take that into account. So I wouldn't say that anything in the past few weeks weighed on the committee, except for trying to make judgments about the fundamentals of these situations. Okay.
Ed.
Ed Conway from Sky News. Actually, first of all, can I ask, in this new era of transparency, do we just have one question per person, or are we allowed two?
There's a lot of people to get through, Ed, so I'd rather you start with one, and then
I will
if
limit
there's
myself.
time, I'll come back to you afterwards.
So, last time around in May...
And that was your one question, Ed. Sorry.
Last time around, you were quite worried about productivity, and you mentioned that a number of times in the last inflation report. I just wonder, since then, we've had the summer budget, we've had the government's productivity plan. Can you reflect on those and say, you know, are some of those issues now actually being solved, or do we still have a productivity problem?
Well, no, first thing, with all due respect to productivity plans, those are plans for the medium term. And they'll have an impact. Their impact will be seen in the fullness of time, and they're not hugely relevant for the horizon over which we conduct monetary policy. In terms of the productivity puzzle, we have been disappointed by the length of time it has taken for productivity to pick up in this economy. There are a variety of reasons that we could there are a variety of ways we could cut the data and justify why it's taken time without fully explaining it. I think we've been open that we can account for some of it, but not for all of it. So I would say we are mildly encouraged to see the most recent data, which does have a pickup in productivity. Now, I just want to be clear what we have done with that is we haven't run to the other side of the boat as a consequence of a few, good reports. We have taken about half of that improvement in productivity into the forecast. So the level of productivity at the end of the forecast is about 0.6 percentage points higher than it had been in May. And so what you'll see in our forecast is that the rate of productivity growth over the forecast is slightly lower than we had it in May. That's that's being prudent. There's probably going to be there's always some volatility in the data, and it doesn't move in the productive process doesn't move in a smooth line. So we brought that in. But I would go back to my earlier comment, which is that it is encouraging because the tightening of the labor market, the combination of the tightening of the labor market and the improvement in productivity support faster wage growth. And so the pickup in wage growth that we have seen and we expect to continue is more firmly grounded in that environment.
Siobhan and then Phil, please.
Siobhan Kennedy at Channel 4 News. Just to clarify, Governor, on the Lincoln speech, do you stand by then what you said about the potential for rates rising at the turn of the year? Because everything that we've heard today would imply spring or even June of next year. No, so the two things seem a little bit confusing.
Well, let me clarify for you. I'm not sure it's necessary. First thing is I recommend reading the actual speech because I didn't say rates increase around the turn of the year. I said exactly as Richard Edgar, who had read the speech, that the decision around that comes into sharper relief. That's the first thing. The second is that the forecast of the MPC, which takes into account a variety of things that have a variety of developments, does not deliver a sustainable return of inflation to target. It brings inflation back to target in 2 years, but it then overshoots. The economy then moves into excess demand. And so a judgment that has to be made individually and ultimately collectively by members of the MPC is, all things being equal, how would one adjust policy in order to have policy slightly tighter than where the market is, which can be an adjustment in terms of timing of the start of rate increases or the cumulative amount of rate increases. And those are judgments that we'll make. Taking a decision in August, Siobhan, a decision in August, which is not the turn of the year, about whether or not to raise interest rates today is entirely consistent with what I said in Lincoln.
And Phil.
Phil Aldrich at the Times. There's conflicting data in the labour force stuff. You've got unemployment has been picking up a little bit, but you've also got wages rising strongly. And the bank, you do a bit of analysis on this, but you don't actually set out a conclusion. And I just wondered if you can provide some clarification around whether you think the labour market is indicating that conditions are tightening on the balance of probabilities, or whether the labour market is still providing ample room for slack, and there really is no tightening happening, because it is mixed messages coming out of the report.
There are cross currents in the labour market. There's cross currents in the economy, because we are seeing in the supply side of the economy, because as you observe, longer suite of time, there has been this big labor supply shock. It's largely been absorbed. We've had a slight uptick in unemployment in the course of the last few months. But at the same time, we have seen a concurrent pickup, apparent pickup in productivity. What the MPC has done is we've taken all those factors together and made a judgment about the amount of excess supply in the economy, the output gap, if you will. Our judgment is it ends up in roughly the same place as it was in May, about 0.5 percentage points of GDP. Now, there's a wide range of views on the committee about exactly where that is, and it's an inexact science, to be polite. So we do bring it together we bring it to conclusion around the output gap. But let me say a word about the labor market. I actually might ask Ben to supplement, which is that the bigger picture in the labor market is that the labor market is tightening, and it is tightening, and wages are beginning to reflect that. And as I said to Ed Conway earlier, that the performance of productivity, all things being equal, to the extent it's sustained, is supporting that wage growth, which is a welcome development. Now, when you turn to actual labor income, then you get into some complications. But Ben,
I won't add much. As the Governor says, it's only in the very latest data you see this rise in unemployment. The data are also quite volatile on short-term basis, so we'll have to see whether this persists. I might add that, of course, our forecasts have for a while implied a slowing rate of employment growth, and that's broadly what we're seeing. Over the last 2 years, we've seen a significant tightening. That's true in the rate of unemployment. It's also true in other indicators, as the Governor said, like vacancies. A combination of that, plus now a degree of productivity growth, is boosting real incomes, and we will see this year significant growth of real labour incomes. So I don't think the very latest data disturb a broad picture, which has been a feature of our forecasts, I would say, throughout the last year.
Jennifer Ryan from Bloomberg News. I've got a question on the pound. It seems to me, just from your opening statement and some of the remarks in the minutes, that the pound is really doing a lot of the tightening for you, and so that's really the key factor in postponing an interest rate increase. But I would also wonder how confident you are in your projections for inflation, given that the last time we saw a big move in the pound, i.e. down a couple of years ago, the bank's forecasts didn't do so well, and this was obviously admitted by, after the fact.
Yeah, no, very timely. Look, there's been a big move in sterling, 20% on a trade-weighted basis since the trough of March 2013, and a good, a notable chunk of that has come between May and today, as well. What we have to do, and there is substantial exchange rate pass-through in our inflation forecast. It does do a fair bit of the work in terms of, as you say, keeping inflation down, not just in the short term, but over the relevant policy horizon. And it's one of the reasons we need to see domestic costs come up. So one of the judgments we have to make is how much of this is going to flow through to consumer prices. And we have been, as you would expect, looking very carefully about what the recent history is, not just the farther back history. And there has been less of this being passed through than we had previously assumed. So one of the adjustments in this inflation report is just to take that reality, the fact that there has been less pass-through, and we've adjusted our forecast accordingly. So there's no question that the strength of sterling, persistent strength of sterling, is having an influence on policy, and it's one of the factors. But it has to persist. We will take it into account. But even taking it into account, the strength of sterling, and even taking into account the fiscal consolidation that we're going to see over the coming years, and the weakness in global demand, we see robust private sector growth here, and consistent with that is a need to begin to increase interest rates, and the precise timing will be determined. And as you've heard me say many times, it will likely be limited and gradual. But the sterling hasn't taken away that requirement. Yeah.
Mr. Carney, there's been a lot of focus recently on the Office of National Statistics and some of its data. It's even been criticised by the UK Statistical Authority, and obviously a lot of this data is what you're making your forecast based on. How concerned are you about this and the rest of the committee?
Well, we have to work with what we're given. No statistics are perfect. They're all, in some respect, based on some degree of surveys. I would say we have the committee, and certainly the staff of this institution have a great familiarity with the data we use, and a very close working relation with the Office of National Statistics to understand what's coming out. And you see it in our forecast. I'll give you one example. You see it in our forecast, both in terms of when we forecast GDP, we forecast what is expected to come out, but more importantly, we forecast what we expect it ultimately to be measured as, so the so-called backcast. And often there's quite a substantial difference, and in general, those forecasts of the backcast have proven accurate. Obviously, we care about this issue a tremendous amount, as does everyone at the ONS. We're very pleased to see Sir Charlie Bean be appointed in his new role. We have seconded people to assist him. I can think of no better person in the country to do the important work he's doing. And I'll just finish with, I think we do need to put this in context, which is that all statistical agencies have to continue to get better. It's a constant effort to improve. The economy is always shifting, resources are always scarce, and the ONS is doing the best they can with the resources they have, and I'm sure they will be improved by Sir Charlie's work. Thanks.
Emily and then Ben.
Yeah.
Governor, Emily Cadman, Financial Times. Your forecasts make quite clear that you think the consumers are going to be fundamentally the driving force and behind the recovery. Savings ratios declining, house prices going up. Is this sustainable and balanced going forward?
Well, I think the first thing is to recognize that this is not a debt-fueled consumer recovery. We have had British households have paid down about 30 percentage points of debt relative to income over the course of the last several years. We would see only a modest sort of flattening of that trend over the forecast horizon. So households are consuming out of income. They may be drawing down their savings rate, as you rightly note, over the course of that horizon, but they are being paid. They're in work. Their wages are starting to increase. We think that their incomes are going to rise further over the forecast horizon, and so there is absolutely a sustainability to that aspect of the recovery, particularly as productivity starts to fill in and make the expansion more sustainable.
Ben Chew from The Independent. Governor, a question about business investment. You've revised up your forecast for investment this year and the subsequent 2 years, and the inflation report tells a quite optimistic story about business investment. But the chief economist of the bank, Andy Haldane, recently gave a speech where he presented a less optimistic picture, and he said that there might be a potential structural break on investment due to the short-termism of equity investors, and he suggested that might be one of the reasons why it's underperformed since the financial crisis. Is that a minority view amongst the MPC and the bank staff, or is this something that the bank, and an area that the bank is actually looking at?
Yeah. Well, the first thing is, thanks for the question. I mean, the first thing to observe is Andy is a member of the MPC, and he signs up to the forecast. So this is the best collective judgment of the MPC, and as you rightly note, at the heart of the forecast is this pickup in business investment. I think we have to remember that there was a few difficult years here in the past where business investment was not strong, not just because of the absence of demand, but difficulty in obtaining financing. Now we have certainly strong domestic demand. We have a financial system that's working, that's virtually firing on all cylinders. If you look at financial conditions as a whole in the country, they have continued to improve over the last several years, and they're quite attractive both in terms of cost and availability of finance. So it's more a question of opportunity. I would pick up on the short-termism element, and I would put Andy's speech, if I may, into its proper context. He's looking really at a medium-term issue. He's looking at issues of principal agent problems, corporate governance issues, the structure of compensation, the incentive structure around quarterly reporting, other issues, all important issues. But these are medium-term structural issues as opposed to questions which pertain specifically to the forecast. And I'd underscore that, yes, we have a strong forecast for business investment, but it's consistent with strong domestic demand. It's consistent with very healthy financial conditions, and it's consistent with what we're hearing directly from businesses themselves, both in terms of our surveys and broader SIPs and other surveys. So, do you want to?
No, just to point out that you can see this in a chart, the chart on page 14, 2.8. Fact is that business investment already has been growing very strongly over the last couple of years. You can see it, the growth rate hit 10% early last year. And this is what tends to happen in economic recovery. So actually, I would say, not untypically, this is as much, if not more, an investment-driven recovery as it is consumer spending-driven recovery. So as the Governor says, I think Andy's points were more about the medium term. That does not mean that one should not expect to see the usual cyclical recovery in investment. It is much the most cyclical component of aggregate demand.
Richard Barley from the Wall Street Journal. Governor, could I take you to a couple of lines in the minutes, one of which talks about moving rates earlier, allowing a more gradual adjustment, and on the other hand, an environment of heightened uncertainty, the benefits of waiting for more information might be beneficial. Is this heightened uncertainty a fair judgment, or is it a post-crisis oversensitivity to uncertainty? In the future is always uncertain. When we get to the turn of the year and these issues maybe come into sharper focus, things may still be equally uncertain.
Things are all, Richard, a couple of reasons I want to thank you for the question. I think the first thing is you pick up on something in the minutes which reflects a discussion that we obviously is appropriate, reflects a discussion we have. But we have, from time to time, as you would expect, sort of step back, conceptual, strategic discussions, if you will, deliberation-type discussions. And what that refers to, that bit of the, and part of the point of this process is actually that you get to see the minutes, you get to ask us questions, and we can explain it in real time, as opposed to you just ponder them and then lose the opportunity. That bit in the minute refers to issues around, a risk management approach at the zero lower bound versus some work that Charles Evans has done on the benefits of waiting, which are interesting theoretical / policy questions. I would say, to characterize the central view of the committee, very much the collective judgment of the committee, is that neither pertain to the United Kingdom at present. So we're not sending a policy message here today that, oh, the world's also uncertain, we can't decide what to do. Actually, there's always cross currents, as I said earlier, but we have a recovery that's turned into an expansion that's built solidly on robust domestic demand. We have tightening of capacity, tightening of the labor market. We have very low inflation at present, but gradually building inflationary pressures. And the question is when to begin a process of beginning to increase interest rates in a limited and gradual fashion in order to keep inflation around target over the medium term. So no, we're not. I entirely agree with your characterization. When next time we're in front of you, there will be lots of uncertainties, some of which we won't have predicted. But that's not a justification for permanent stasis.
Hi, Harry Daniels from LiveSquawk. It's a question really from my listeners saying, on the MPC, is there any sympathy or consideration to the neo-Fisherite view that a sustained period of low interest rates could be contributing to low inflation rather than preventing it? So in the sense that I know expectations of society to rise, but slowly.
It certainly didn't. I don't recall it characterizing any of our discussions. I think what I would say, just to go to that question, is we did have a discussion. I think there is some sympathy that low interest rates can contribute to a sort of passive forbearance in the financial sector, which, as a consequence, can delay some of the necessary reallocation of capital, births and deaths of companies, if you will, that are necessary to support productivity growth. So on the margin, that's one potential explanation. And so you certainly can have an environment as rates increase that's actually pro-productivity, if you will. Now, I wouldn't overplay that. I wouldn't say that's central, but that's the one observation. It's not a factor that we're not making that inverse.
Mike Bird, Business Insider. I just wanted to ask, the labour market and wage figures were a little bit surprising in comparison to what was thought in the May inflation report. For once, obviously, wages surprising to the upside and employment to the downside. Is there any concern about the bank's understanding of what's happening in the labour market, given that it seems to have missed this trend a little bit, and a couple of years ago it very much missed the trend of much stronger employment and much weaker wages and productivity.
I wouldn't call this a trend. I mean, as I say, we've seen it in 2 or 3 months of data. I think we need a little longer to call something a trend. And every forecast has an error surrounding it. And as I said to an earlier question, actually, if you look at the shape of the path of unemployment, do it from your perspective, and indeed wage growth, the broad shape is actually, I would say, close to what we've been forecasting for quite some time. So yes, looks like in the second quarter of this year, wage growth will have been a little firmer than we were expecting in May. Employment growth weaker. As it happens, that leaves the most crucial single number from the labour market, the growth of unit labour costs, pretty much exactly where we expect it to be, just marginally below. You referred to the forecast of unemployment and how rapidly it fell 2013, 14, and that was surprising, and it's a part of or associated with this productivity puzzle we've had. And as the Governor said earlier, we have some ideas about that. We're never going to explain it fully, I think. But I wouldn't actually call the variations we've seen recently to be on the same scale as that. I don't think they are.
Thank you. Hugo Duncan from the Daily Mail. Governor, is the overshoot in inflation 3 years out that you spoke of a few minutes ago, is that a sign that interest rates will probably rise faster or may have to rise faster than the market is currently expecting, as you detail in the inflation report?
I think what it says is that in the committee's best collective judgment that the market curve does not deliver a sustainable return of inflation to target because there is an overshoot. The economy moves into excess demand. Now, there are a range of outcomes around that. That's why we have inflation fan charts, but that's the median of it, yes. Yes. Yeah.
Hi, Sam Nussey from Nikkei. In the July minutes, it was noted that the appreciation of the exchange rate could have an adverse impact on the balance of growth in the economy and has had occurred despite the large current account deficit. Are you concerned that the rise of about the rise of sterling, the impact that could have on the balance of growth, and whether it could be a risk for economic stability in the future? Thanks.
Well, I would say, let me speak for a moment. The three of us are members of the Financial Policy Committee, which looks at issues of economic stability, and the current account deficit is one of the top risks to financial stability over the medium term. It's sizable. In fact, we used it to motivate our stress test of banks last year. That there could, if there were a disorderly adjustment in the current account, what are the knock-on effects for prices, for interest rates, for unemployment, and ultimately the housing market and bank balance sheets? That is not the base case that we expect, and in fact, the very process of going through that makes it less likely. That's part of the point of stress tests. But yes, we do think about it from a financial stability perspective. And one of the things that we're doing as an institution is to ensure that the Financial Policy Committee is talking to the Monetary Policy Committee so that we have we can share analysis and perspective, but we also understand each other's concerns and what we might do about it. And those discussions include discussions around the current account.
Mario Blaszczak, World Business Press Online. Governor, I would like to return to graduality issue or graduality terminology. Have you ever considered at MPC other than 25 basis points move in interest rates because there is a long, at least a year of a history of gradual and limited interest rate increase. So would 10 basis points do the gig? Okay.
I'll give a straight answer. The term gradual refers to relative to past cycles. The average increase, once the Bank of England starts since the adoption of inflation targeting, once the bank had started raising interest rates, the average increase per quarter was on the orders of magnitude of 37 and a half,
Yeah.
50, 37 and a half, right? 37, well, 37 and a quarter. 37 and a quarter. There you had the per quarter, exactly. 37 and a half per quarter. So it's relative to that level in terms of rate increases per quarter, which gives us a sense that we would proceed more slowly. Directly in terms of your question, no, we have not had any discussions of changing interest rates in anything other than the increments, the traditional increments of 25 basis points. And to be clear, of course, one of the advantages of the minutes is you see the proposition that is put in front of the committee. And if we did ever have a discussion, just to be absolutely clear, if we did have a discussion about something like that, we would include it in the minutes and we would disclose it so that you would know and raise it with us.
Hi, Kieran Williams, Livestock. So we've recently had some upper revisions in the 2012 and 2013 GDP figures. So seeing as the employment figures won't be revised over those periods, that suggests productivity was stronger in recent years than was actually thought, which also means that productivity is close to its potential level. So how do you anticipate that will affect your estimates going forward?
Yeah, well, it's relatively modest in terms of productivity. I think it totals to about a percentage point cumulative over the course of the 2 years, and the drift of productivity from potential, historic potential, if you will, is north of 15 percentage points. It's probably around 17%. I mean, it's a big number. It's such a big number, I'm not even tracking it anymore. Now, we don't expect the economy to go back to historic potential, not least because part of that trend of growth, not least because part of that was from North Sea oil and gas, and obviously the economics of that have changed. But a notable proportion was from the financial sector, which proved to be more ephemeral productivity, and having put it on the right track, we would expect the growth of productivity in the financial sector to be lower than in the past.
Giuliano, Financial Times. Governor, I have a question about the appointment of Gertjan Vliege, which happened last week, and the following comments by Andrew Tyree from the Select Committee of his business interests with Brevan Howard. My question is whether you think in retrospect it was the right decision to allow him to retain those ties. He then eventually sold the stake, but I was just wondering whether this initial decision was right. Especially as it later emerged that he could actually cut his ties with the hedge fund. So I was just wondering what your opinion was now.
Yeah. In the full hindsight, well, let me say a couple of things. First, I'm very much looking forward to working with Jan. He's an outstanding economist. He's known to the bank. He's someone who has gone out and gotten more financial market, private sector experience, and he's coming back to serve in the public sector, and he should be commended for that, and very much look forward to working with him, as do all our colleagues. In terms of appointments to the MPC are made by the Chancellor, and determinations of conflicts of interest and others are made by the Treasury. So they made the determination. I'm a little loath to pass judgment on those. We have a code of conduct for members of the MPC. And the judgments in consistency with the code of conduct is judgments made, the financial aspects of somebody's personal affairs, as you would expect. It's not a judgment that I make. I don't oversee the financial affairs of my colleagues on the MPC. Somehow I could imagine that might create a conflict of interest somewhere along the line. So it's overseen by effectively our compliance within the bank, our Secretary of the Bank of England. And Jan's arrangements were consistent with the code of the MPC because it was a passive stake. Now Jan took the judgment to eliminate any possible misperception of a conflict to exit his stake, and he arranged that, and I commend him for it. But I'll go back to my first comment, which is I very much welcome his willingness to serve the British people and look forward to working with them.
Yeah, I had a question up there, and then we'll go round again.
Hi, Dan Hinge from Central Banking. So this was the first meeting under the new format. I wondered if you could talk a bit about whether the nature of discussion had changed at all, given the increased scrutiny, particularly of the second session.
The nature of discussion, I wouldn't say the nature of the discussion changed as a result of the format. I would say, and hopefully it bears out, that well, you'll be the judge, but my personal impression is probably a sharper connection between the minutes, the inflation report, and we've added what we call a monetary policy summary, which is quite helpful, because that is, in effect, it's the first place I would go in terms of the thinking of the committee. How do we see the trade-off at present? Over what time horizon do we think we need to bring inflation back to target? What's our strategy to do so? And then the main elements of the forecast. So for the first, we're stepping back. Now that's something, many of those elements will look a bit familiar this month because many of them are in the letter to the Chancellor, but where this will be particularly relevant is when we don't have to write a letter to the Chancellor, when we're back within the zone, we still will have the discipline. And I think the discipline of stepping back to that was helpful as well in terms of forming an opinion on it. Manoush, do you want to?
Yes, I mean, I think, as you said, the minutes, I think, are fresher because we prepare them immediately after the discussions, and I think that's a good thing. And the consistency across the three products, I think, is also better. So I think as members of the committee, we thought the staff did an excellent job of pulling it all together so quickly in time for all of you today. Robert.
Obsess about when interest rates are going to rise, but it's also sort of some importance that you own 375 billion quid's worth of UK government debt. You took the decision in the latest meeting to reinvest 17 billion worth of maturing debt in new bonds. Why isn't this the moment to start paying or reducing your holding of UK government debt? And if this isn't the right moment, when would be the right moment?
Right. Well, the first thing, let me just state what the policy of the MPC is, because it's an agreed policy of all of us, is that we will continue to reinvest any maturing proceeds at least until we begin to raise interest rates. So with that policy, it sort of mechanically follows. And that's to provide guidance to the market, clarity to the market, that our marginal instrument of monetary policy is going to be the interest rate. It's going to be bank rate, at least initially. We further said that we will not sell any outright sales of any of our gilts until we have raised interest rates to a level from which we can materially cut them. Again, the common theme behind both of those points is that we want to use bank rate as the marginal policy, the marginal instrument of monetary policy. There's lots of uncertainties and imperfections, et cetera, but we have a much better sense of the transmission mechanism of changing interest rates in this economy than we do for a given adjustment in the level of gilts. And I think the market also would have a much better sense for a given change in interest rates on what prospective future interest rate changes might be, as opposed to discrete decisions about whether we reinvest this lot of gilts or sell that lot of gilts. I think your question, though, goes to an important point, which we have discussed as a committee and will develop over time, which is to think about how we can provide greater guidance and clarity about our plans for that stock of debt. I'll be clear that these are decisions of monetary policy. These are monetary policy decisions because they will affect overall conditions and affect our ability to hit the inflation target. We will want to coordinate those decisions as much as possible with the Debt Management Office, because 375 billion of gilts is a material amount. And what's incumbent on us is, and Manoush is leading this work, is to work through and then provide as much clarity as possible in advance about a potential program. But all of that presumes, first, movements in interest rates, and for anything above decisions around just reinvestments, likely material moves in interest rates before we would make those decisions.
Hi, Sue Chan from The Telegraph. Governor, could you give us perhaps a deeper insight into any changes in the mood music between the July meeting and the August meeting in light of the new forecast? Obviously, the minutes show a clear divergence, with one member voting for a rate hike, another saying there's risk to sort of wage and price expectations in the near term, maybe holding off. Would you say that more members are thinking about upside risk to inflation forecasts than a month ago?
Well, I think let me first go from May, which is that there were some big developments since May that would have otherwise pushed down on the inflation forecast. So we had a big move up in sterling, 3.5 percentage points. The rate curve moved up to a notable amount, and depending on how you interpret the labor market data and productivity, there's also there had not been a reduction in spare capacity as much as we would have expected. Now, set against that was a reduction in some of the external risks, the Greek risk specifically, although there's still residual risk around Greece. We shouldn't forget that. But reduction in some of the external risks, and this continuation of domestic momentum, robust domestic momentum, investment-led, as well as household consumption, and supported by wages. So for a number of members, it makes these decisions, more pointed, and they reflect on it. I think the minutes faithfully represent where the committee is, as you would expect. There's the specific vote on whether to move rates today, which is 8-1 not to. There's some of those members see more upside risks to the inflation forecast than others do. And these are fine judgments. It's absolutely appropriate in a committee of 9 individuals that some would think that, for example, there's a little less slack, there might be a little less pass-through, the economy might have a little more momentum, and all of that would play into individual perspectives on the timing. So I would just draw your attention. I would draw your attention to that. Look, as the economy progresses, and if the economy progresses broadly in line with this forecast, the decision about when to move interest rates is going to come into sharper relief. That's the way it works. And there were some big changes between May and August. But as I said in my opening remarks, as a whole, in the judgment of the committee, we're moving closer to the point at which the first interest rate increase may happen.
I'm afraid that's all we've got time for. Thank you, everybody, for a long morning. Thank you.